Good morning. How are you? It's a great morning. Have my coffee with me. I hope you have a cup of coffee too. It's going to be a great day today. I was reading a book that I thought was really interesting. I've read it before, Psycho-Cybernetics. And there's an interesting thing about your real, what is it? Your real personality. And I thought that was very interesting. If you don't have this book, I'd take a look at it. But I want to get on topic now. The topic today is, how are you keeping your money safe? That question that comes to mind to a lot of people. I was reading a New York Times article, and the article was talking about a guy who had a wallet of Bitcoin, and he was out there, wanting to be safe and password protected it, and it grew to $220 million, and he lost his password, and he couldn't find it. So he did everything right, but was his money really safe? And it got me thinking about, what is the definition of safe? Because when I think about the first car that I bought, it was not very much money, and it would cost multiples and multiples today to buy it. I think one of the biggest risks right now for people is just keeping up with the inflation rate and keeping up with taxes, because those two numbers are eating at our money so much. It's actually, the numbers are staggering. I was actually calculating the numbers up. Get this. So if you're just in a 3% inflation rate, which is roughly about where the average is, if you have a 3% inflation rate and your marginal tax rate is 20%, which is very, very reasonable for many people, in 5 years, your dollar is only worth 69 cents. In 10 years, your dollar is only worth 60 cents. And in 20 years, it's only worth 44 cents. In 30 years, it's only worth 33 cents. So just to kind of put this in real numbers, if I bought just an average sedan car today, it would be $36,000. That's about what they're going for right now. And $36,000 car today, right? Now, most people, when they retire or when they get to the point where they're financially free, they generally have 20 to 30 years left. So let's say it's 20 years left. That car at the end of your retirement is going to cost you $60,000. So that's a real big problem, right? It's a real big problem. So safety is not being generated by putting your money under the mattress. Putting your money under the mattress is not a good way to be safe, because you have to just to stay even, you got to break through those numbers. So the rate of return has to be a lot higher. So how do you safeguard your money? Well, there's really three things. And before I get into that, I would like to know, what is your definition of safety when it comes to money? And how important is that to you? Just type in here really quick, what is your definition of safety? Now, when I think about safety, I think about keeping up with purchasing power. I think about paying for your taxes so that I can actually spend the money to have the same lifestyle or better. So, and this is where I want to kind of differentiate between real wealth and just having money. Real wealth is when you can't outspend it. Like, you are ahead of inflation, you're ahead of taxes, and you have enough there. So if you're at the point where you don't have real wealth yet, I want to really talk to you, because what we're talking about is attaining real wealth. And so I'm asking you guys to type in the comments, how are you keeping your money safe? Or what is your definition of keeping your money safe? And the point that I made earlier is that with inflation, a car today is $36,000, right? For just a normal sedan. But if you held that car for 20 years, if you needed to buy a car, in 20 years from now, it's going to cost you $60,000. So in order for you to have safety in your money, you really got to keep up with taxes and inflation. So how are you keeping your money safe? So I want to talk about some strategies for keeping your money safe. First of all, you have to beat taxes and inflation, so you can't just stick it under the mattress. That's point number one. Point number two is, if you buy safe investments, there is no return. Actually, I was talking to Jeffrey Gitomer, and he said, I told him, no pain, no gain. I was talking about investing, and he said, you know what? It's not no pain, no gain. He said, no risk, no nothing. And he said, absolutely right, because you get nothing. In fact, you go backwards with no risk. Let's say you put money in a CD right now, treasury bill, something that's quote unquote safe. You're really going to go backwards. So you have to go forwards. And in order for you to go forward, you have to take some level of risk, but it has to be done in a way that's smart. So safeguarding your money requires a few different things. The first thing is really there's three big things you have to do. Number one is you got to plan, because if you don't have the right plan in place, then you're not going to have the right structure with your investments. Number two, you have to protect the money. So you have to have strategies that will actually preserve the capital when markets get rough, or with the investment the investment world gets rough. And number three is you have to invest that money so that it grows. So there has to be an expectation of growth. Now, each one of those have multiple things. So let's talk a little bit about the planning. In the planning world, there's 7 steps to planning. Identify and prioritize your objectives, develop realistic solutions, right? Analyze your current situation, prioritize your goals first, right? Analyze your situation, develop realistic solutions, implement your plan, monitor your progress, and then you keep that going on and on and on. That's kind of the 7-step process that is needed to do good planning. So that's the basics, right? Once you're past that, you need to safeguard and grow. So in order to safeguard your money, let's start off with the protection of capital. In order to protect your capital, you have to put in place where you have risk management, what I call predefining your risk. So predefining your risk means before you put your money into anything, you're predefining how much I'm willing to lose in that investment. Because all investments are expected to do well, but some will not do well. So you're always looking to make money, but you want to also, be in a situation where you are predefining your risk. The second thing you have to do is diversify. It's really simple, right? Diversify. One of the problems that we see is that there's a lot of people that think they're diversified. They have a bunch of different funds in their 401k, but there's a ton of overlap, and there's actually a bunch of securities. You could look underneath the hood and you could see a ton of stocks and bonds that are owned by all these funds. And that's why they're moving up and down together. So you think you're diversified, the market gets a little rocky and you have big losses. So you want to avoid that. So by being properly diversified. So, and then there's asset protection. Protecting your assets legally is another big part of it. So you want to talk about planning. We talked about that. Then there's the protection, and then there's the growth. Now, in order for the growth to happen in today's environment, I think you have to do things differently than the past, because we're in a innovation and disruption economy. We're in an economy where new products and new services are being developed, and technology is disrupting companies. So you have to be investing in those companies that can adapt, those companies that have desirable products, and those companies that are in a position where they're going to be winners. And you have to avoid those companies that are stodgy, unable to adapt, and that are part of the past. So if your parents told you that you have to invest in Verizon because it's a good company, it's always been stable, that's not a good process today. So you can't stick it under the mattress. You can't, because taxes and inflation will kill you. So, and you can't actually be too aggressive. If you don't have risk management, then that's something I'm amazed. People don't want to talk about risk. They only want to talk about the positive. But you should be going after the positive with measured risk. So that's really my discussion with you today. I want to know, how do you keep your money safe? What is your definition of keeping your money safe? So in today's environment, we saw a lot of stocks that went up, and a lot of people are feeling pretty good because things have gone up. But recently they have not been going up as much. But keep in mind, most people are in a position where there's uncertainty out there, and there's a feeling of ambiguity, and that is creating angst, because people want to have clarity. In order to get that clarity, it requires planning and guidance, right? Planning through those processes. And once you get your clarity, then you can actually go for that preservation to protect your money and to grow your money in this environment. So how do you define keeping your money safe? Is it sticking it in the bank? You could just type it into the comments right here. Right here. So how do you keep it safe? Bank? Yeah, I'd like to know. Let me know. And another thing I wanted to mention to you was that in today's environment, when you were trying to find these adaptable companies, you have to know that you got to cut your losses when things are not working out because the unexpected happens. And when the unexpected happens, you got to be able to cut back. So, keeping your money safe is what we're talking about today. And I think a lot of people are concerned about keeping their money safe, but they're not quite sure what to do. They're kind of frozen. Most people I've noticed who are doing it on their own are frozen. They're going, things have been kind of good. I've got my funds, but they're just sitting there. They really don't know what's in the funds. They don't really know how many securities are overlapping. They don't really know whether or not they're going to be able to meet their goals. And that's where the planning really helps. Being able to meet your goals. And without the planning, you're really lost. So I don't think the bank money is safe. The bank money is not safe because you're going behind. After you pay taxes and after inflation, you lose 60% of your money pretty quick. The average person, when they retire, will find that their expenses will more than double while they're retired. And they don't really plan for that. So you got to do that now. You got to plan for growth. And there's so many great growth opportunities. It's just not a straight line. We would all love it to go up 12% in a straight line, but it doesn't work that way. And but having that right balance is the right thing to do. So I think it makes sense to have real assets like gold and Bitcoin. Bitcoin is not really a real asset, but I would call them alternative assets. Real estate, that's going to hold its value. The biggest risk people have is losing money to taxes, inflation. I've said it like 5 times already today, but I think people need to really think hard about that. I think good stocks are going to do well. Stocks that can beat inflation, stocks that have new products and services in high demand, and being diversified across sectors. But I would stay away from the bank. Obviously, you need a cash reserve, but cash is not king in today's environment. So let's see. Alex Moreno says, diversify your portfolio with some uncorrelated assets. Okay, that's good. Uncorrelated assets is a good start. Now, I think having uncorrelated assets is good. Understanding what correlation is about is important. So let me explain what that is. Correlation is the degree to which investments will move up and down together. So basically, it's a calculation that's analyzing the variance. And if the variance tends to be, if it's a number of 1 on correlation, that means they're moving perfectly together. If the number is -1, that means that they're moving exactly opposite. And very rarely do you have one or the other. The trick, though, and one of the issues is that correlation is a very big moving target, okay? So if you look at correlation between asset classes, they move up and down quite a bit, and they're actually not a stable parameter is what we call it. It's not a stable parameter. The most stable parameter is actually volatility. So we use a method called SRP. It's a proprietary method that we use for that, where we have a signal strength based on the opportunity of that investment. The better the opportunity, the higher that score. And then we have the R, which is the risk factor. And risk is in 2 things when we're dealing with risk. It's how volatile that you actually see that investment, but it's also based on the risk of the underlying fundamentals. So if it's a stock, if we look at the revenues and the costs and how volatile and how unknowable are those revenues and expenses. And that generates a more holistic risk view. And then there's the P on that, which stands, it's a kind of a symbol for correlation. And when we're looking at correlation, we split that into 2 as well. We look at correlation versus observed correlation, which is how much does the assets move together, like you can actually see, statistical correlation. And then the other is what is the correlation of the fundamentals? What are the risk factors of each particular investment, and how much overlapping risk factors are there? For example, do you have one stock that's in the energy sector, but then you have another stock that's not in the energy sector, but it's highly exposed to energy, even though it's not in that sector. So you might look diversified, but you're not diversified. And it may not show up in the correlation numbers. but you're still exposed to it because the correlation numbers are dependent on the data set that you're looking at. So having that kind of a view is really, really important. So that's one way of diversification is one way to get more safety. As long as you have a positive expected return in your strategy in the assets that you're holding, then that is true. Because you could have investments that are not correlated that don't have a very, very good expected return, and then you really are not safeguarding your money because you're moving behind. So without an expectation of return, you have to have that return element as well. So the other part about being safe, Alex, I liked your answer, by the way, is to actually think about how you actually time your money, because people will tell you you can't time the market. The very best investors always have an element of time in their investing. So you could be passive where you just own everything and it's market cap weighted, but you're leaving yourself exposed to big risks because you have more of your money invested in assets that are the largest, and generally they tend to be the most overvalued. And when you have a correction, the first ones to go down the most are the ones that you have the most amount of money in. So, and I've seen this happen over and over and over again, where you have people that are thinking that they're going to index forever, and then as soon as you have a bear market, they bail. So I've seen that in my career over the last more than 25 years. I've seen that happen several times where indexers bail, and they bail at the wrong time, and guess what? They don't get back in at the same time. Most people can't handle the volatility of the 50% drawdowns that occur in the S&P 500 type funds. They shouldn't be doing that. They think they should do it because they can see the really, really long-term numbers. And by the way, there is no rule that says that the stock market must go higher always. Just take a look at the Japanese market. The Japanese market went nowhere, and is actually still, as of last time I looked, the Nikkei 225 was still underwater from before from the dot-com era. I mean, it's still underwater. So there is no rule that says that stocks have to go up. And guess what Japan was doing, by the way? Japan was doing what we're doing right now, printing a lot of money, bailing banks out, all of that. So, and that stock market has gone absolutely nowhere for a long, long time. So risk aversion, yes. Risk aversion is an interesting concept. If you understand modern portfolio theory, which I'm not a huge component of, I think it's a neat way to kind of think of things, but it doesn't really work in the real world, but it's a good framework. The concept of risk aversion means that you basically shy away from risk for the same amount of return. So if you have two investments, one with an expected rate of return of 10%, and the other one has an expected rate of return of 10%, so they have the same return expectation, all else being equal, you would pick the one that has the lowest risk between those two. And if in a rational world, everybody would do that. And in the real world, that's not necessarily always true. And you can observably see that. There are times when volatility tends to outperform low volatility. Over the long run, low beta, low volatility tends to outperform high volatility as a factor. But it has big moves, trends up and down as to when it outperforms. So we can do something called factor analysis, where you basically take a factor and you run it through models, and you backtest and say, okay, how had this factor performed if I had screened all the stocks that was available at that time, looking for biases and what stocks were available at that point in time. If I invested based on those factors and put them into buckets and portfolios with the highest versus the lowest, which one would have done better? How would it have performed every day, every month going forward? 1 month, 3 months, 5 months, 6 months, whatever, going forward. And what you'll find is that low volatility is outperforms for the most part, but it's very, very streaky. And small cap tends to outperform large cap over the long term, but not by much. Once you adjust it for liquidity and impact costs for when you get in and out, it really doesn't beat as much as people think. So there's periods of time when that works. So having more of a rational approach makes a lot of sense. Safety right now, I think always safety is really important. And that's all I have for you today. So I hope you guys are having a great one, and we will talk to you later.